Rodrigo Nash and Benny, nice to see you again. Hello.
Hi, Mark. Nice to see you.
We wanted to talk about Forex this week, so there's quite a few things going on. Let's talk about the dollar. Let's split those two things into geopolitical risk and economic numbers risk that are being announced this week. Let's take the geopolitical risk first and the threats of military intervention by America into Iran. The US dollar is in the middle of its 5 year range, more or less. It looks pretty boring. It looks as though nothing is happening. You've been a forex trader for 20 years. How does military intervention by the US in Iran, how does that rank alongside, for instance, Gaza or Ukraine?
This is different now because remember, as we spoke a couple of weeks ago about a video about Iran, if the conflict expands outside of the Houthi rebels, which are here and there have been up to today 160 attacks from Houthi rebels into American bases in the region. The market's not paying attention to that. That's very pinpointed. It's very minimal, so to speak. This one in Jordan of a couple of days ago, that changes a bit the picture because now the US's hand is being forced into retaliation. If the US goes into retaliation inside Iran, that could drag Iran into an open conflict with the US.
So
Nobody,
it's interesting you talk about into Iran. So there's two ways the US could teach Iran a lesson, for want of a better phrase, huh? Um,
right.
and it could do it by intervening within Iranian territory, or on one of its rebel bases outside of Iran. How is that?
Yes, which it would be the latter. I don't think at this point, at this stage, they will start an incursion in Iran, an outright war with Iran. Not yet. It might happen that way. The thing is that one of the Iran's argument here is that it's their proxies. Everybody knows it's their proxies, but they're not. It's not crystal clear that they are 100% in control of the militias because they have Iran has trained the militias, has supplied weapons, has been constantly sending funds to the militias, but now it seems to be getting out of hand. So it may be that Iran, I would see the case for Iran being concerned with that themselves and not wanting for escalation. So it might be probably the course of action here will be the U.S. now a stronger retaliation against the militias throughout the region, except inside Iran itself, but now more surface and air retaliation. And as they have been doing already, but escalating that, because there have been a lot of spats so far back and forth between the militias, the Houthi rebels from Yemen, in Iraq, in Syria, in Lebanon, the Hezbollah, backed by Iran, of course. So those pets, the market has not been paying attention to that, and it's usually what happens, right? The market is very oblivious to these things because these usually entail reading long documents and very dense materials. It's not the market's DNA. But when it comes to it's just like Russia's invasion of Ukraine. When it comes to the fore, then it comes all at once. So in terms of market reaction, this is, of course, dollar safe haven seeking. It's dollar positive, and that paradoxically beneficial to the U.S. economy. Wars outside of elsewhere are always beneficial to the U.S. economy. So it will be dollar strong. We should see a stronger dollar, even for that reason, and for the other reason which you mentioned at the beginning, which is the macroeconomic consequence because a conflict in a broader conflict in the Middle East is inflationary because of oil and because of logistics of the routes being disrupted in the Red Sea, the Suez Canal, and elsewhere in the region. So if
Stage
we
below.
see,
At what stage? So we're in this relatively boring trading range. Within the
right,
5 year, but we're in another very, very boring trading range. At what stage would you consider there's been a leg up or a leg down out of into a new trading range? What are the boundaries?
yeah, that's a very good point because from the geopolitical stance angle, that trigger could happen with an escalation of Iran saying, stop using the diplomatic language, as they have been hitherto. This morning they said, let's use the diplomatic route to solve this. And so if the language changes throughout the next few weeks or months, and or in parallel, regardless of that, the US retaliates inside Iran, or even regardless of that, the Iranian militias continue escalating these attacks, because they're killing Americans now. So if that goes on much further, the U.S. will be forced to declare outright war against Iran. That's the level when I say it comes to the fore. That's the level of concern and dynamic that when the market starts to pay attention, and then the dollar appreciates much more.
At what stage would you think the dollar has broken out of its current range and is going to start a leg up, therefore, against the euro?
Against the euro, it would be if it breaks sustainably below 108. We saw that yesterday. It touched below 108, partly on the back of somewhat on these concerns. But the point where that happens more actively, clearly, it's below 107.50. Because then if it breaks below 107 figure, then we don't have much support there until parity. I don't think parity would require a lot of geopolitical concerns, and the other avenue, which is the macroeconomic, because it's a feedback loop. Because if there is a broader conflict in the region, then oil goes up and the logistics disruption, that's inflationary. Then the Fed will say, well, we were thinking of pricing, we were going to cut rates that were priced in the markets already for this year, but because of the Middle East conflict, now we're not so sure of that. Now we're going to take a pause. And then you can easily see the dollar going back to parity or 105, 103 levels. And in other words, the pause or the disappointing of the rate cuts that are priced in the curve being unwound, that would be very dollar positive across the board against everything, all EM and G7 currencies and all that. But I don't think that will be the case. I think that the retaliation now will be stronger, but not as strong as to draw out a war. It's an election year in the U.S. Let's not forget. That's very important, because they would be consuming all the energy, resources, budget. They wouldn't be able to campaign properly. It drains the focus away, and it's Republican. It favors Republicans, right? If there is an outright war with Iran, and there are ads being run on TV every day of the war in Iran, that's the Trump the election handed to Donald Trump on a plate. So they're going to the current administration is going to avoid that for all these reasons.
Is most of the risk to the upside for the dollar than the other way around? Bearing in mind presidential year, geopolitical risk, despite and the economic numbers coming out of Europe that we've just seen that are not very good, with
Yeah.
America powering ahead. Are the risks really in favor of the dollar appreciating in 2024?
Not so many, and that's why I think it's already priced in. We're not too far from dollar appreciation from the peak of dollar. Let's say in the euro dollar pair, it's 108.39 right now. If we're talking about 100, 200 pips further room here in barring a war against Iran in the Middle East. Then it changes, but if it's not that route, we're not too far from the dollar peak. So it will probably be a range bound scenario. It will probably be a sideways throughout the year, where these forces will be pushing, pulling. On one hand, the market for one or a couple of weeks saying the Fed's not going to cut so fast anymore because there might be inflation. Dollar appreciates, but then then the ECB is not going to cut as well, and there's not going to be a war, so dollar depreciates. And then yes, but the U.S. economy is doing very well. Dollar appreciates. So this this tug of war is going to continue throughout the year, very likely within 500 pips, I would say, from 107 to 112 range, which is a trader's dream.
All right, so it's on the downside for the dollar. That's quite a long way from here.
It
So,
is. It
so
is.
beyond 112, you would see that as breaking out of the range and starting a new leg. Is that right?
Yeah, exactly. Well, let's not forget at the end of the year, it was not long ago. It was the last week of December. We were at 111.20 ish about a month ago. So it's we've come. My point. The point being that this is already priced in. That there's a lot of that already in the dollar. The dollar is it began the year on a strong footing. It has been quite strong in the last few weeks because of a potential conflict in the Middle East, because of a potential retracement or bounce back of inflation, of the Fed, the expectation of the Fed cutting too much, 6 cuts this year being too much, that being disappointing to some extent. These things gave wings to the dollar, so it's stronger now. But most of it's already priced in. Again, except the big exception being a broader conflict in the Middle East in the, let's call it 10-15% probability of this spilling overboard and becoming an outright war with Iran. Then it changes. Then it's the parity scenario.
Okay, so that's the dollar. Let's talk about the yen for the moment. The
Right.
yen is creeping back down towards its lows.
Right.
Is
Yeah.
this something that the Japanese, well, the Bank of Japan is happy with? Is it the only scenario that they can envisage because they have nothing else that they can do to counter it? What can they do? Can
Yeah.
they
The Japanese.
160, for
I
instance?
think it was Ueda Kazu himself in the, I think it was in Sintra last year, that he said they're praying, and they are. The only thing that what they do is that they pray, because they were their strategy has been throughout the last, since the pandemic, throughout the last 4 years, to wait it out. So the same way the Fed in the beginning was saying, "Oh, it's transitory. Let's not raise interest rates because it's transitory." The Japanese just zoomed out and say it's transitory. It is. It's just wait 5 years and inflation will go from 0 to 0. Granted, they didn't see much inflation. The peak inflation in Japan didn't even reach 5%. It was much below that. So they're not suffering with inflation. They didn't need to raise rates. They're just being taking a very patient approach. But the weak currency bothers them, because as would bother any other country, especially a developed one. Because if it's a developing country, a weak currency will benefit exports. If you're a country that plants something, let's say coffee, and 80% of your exports are uh, agricultural products, weak currency is very beneficial. But if you're a developed country, you're importing a lot of things as well. So the quality of life is impacted. The quality of life is impacted by a weak currency. Global purchase power dissipates, suffers. It takes a hit. So that is stressful at 150. The $150 yen is the limit of their tolerance. If they see, if the BOJ sees that the US is going to start cutting rates this year, so the dollar is going to subside and inflation all over the world is going to come back to 210, they are tranquil in waiting it out and seeing it, and then believing that the 150 would be a peak. But as you well put, we're very close to that already. So they will probably be tackling that very soon. I think that they will either uh, benefit from, get lucky and benefit from lower inflation throughout the world, or if inflation comes back, they'll have to act. They'll have to do something. They cannot keep YCC at 0
Okay,
forever.
that's something we're going to have to cover in another video then. Especially if the yen starts to creep down even beyond 150. I think that's all we've got time for now. Thank you very much, Rodrigo. I hope to see you next week. Bye
My
bye.
pleasure. See you.